Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, and this is a one-year daily candle chart of the Russell 2000 ETF, ticker symbol IWM. As you can see here, I left my lines on the chart from last week's report where I gave an extended forecast that's about 2 to 2.5 weeks long. I mentioned that early in the week, Monday and Tuesday and Wednesday especially, we would most likely rally and then start to come off. So it's pretty amazing how well the technical analysis signals worked out for us this week, because it's almost as if the market has followed those lines. And of course, we know that's not the case, but knowing how to use the charts to forecast is becoming more and more popular, especially among investment clubs and individual investors and traders alike. So I continue to put out these weekly reports in an effort to educate the public and knowing how to read the signals and especially the indicators. So what does this mean for next week? Well, you can see that today we closed on a red candle right there. I'll magnify that for you. But the interesting thing is that we closed with a lower high and a lower low. So officially we've formed a pivot point to the downside, again, staying directly in line with the forecast that I put out last week. Now down below here we have a gap. It's an open gap. 80% of the time gaps fill, so that means that's going to act as a price magnet. Now if we look down below, you can see that the stochastics oscillator is starting to hinge lower, and today again on September 3rd the CCI crossed with a sell signal. Finally, when the volume drops on the way up, that tells us that the buyers are losing some of that momentum. So I would again suggest that you keep tight stops below the market, protect your profits, and be sure that you use a good risk management plan when looking forward in the markets here. Now let's take a look at SPY. This is the S&P 500 ETF. You can see that again, I left my lines on the chart. Last week I said we would most likely go up. The end of the line right there being my target of 451.94 was hit precisely. And like the IWM, we can see that the stochastics is starting to hinge lower, almost with a cross, and the CCI down here has officially crossed to the downside. So we're expecting a pullback next week in the spiders. So I'm going to put that forecast line just back to the moving average right here. End of the line at 447.63. Now, this brings me to the Volatility Index, which for the most part is inversely related to the S&P. A lot going on here as well. This was my forecast line. Again, hard to see. Let me zoom in a little bit more. You can see that I drew my line to the downside, saying that we would most likely fill the gap right here, because history tells us that 100% of the time gaps fill on the VIX, and then after those gaps fill, 100% of the time prices reverse. So what does that mean for next week? Well, a rally in the VIX would support our idea in a pullback in the S&P. So you can see again, following these forecast lines exactly, we have the stochastics almost at a cross. It's currently oversold, but almost at a cross. And we have these spinning tops here, which are usually found at pivot points. Those represent signs of indecision. So I'm keeping that target in place for the VIX up around 1837, with a longer target above the market for the VIX up here at 2731. Now let's hop to the diamonds. Ticker symbol DIA. This is the Dow Jones Industrial Average ETF. Said we would most likely rally and start to pull back. Look at that. The high on that pivot point is 355.29. And we came right at that high on Thursday the 2nd. We're starting to pull back again with a pivot point. Oscillators are starting to move lower. We have a hinge down to the downside there on the CCI. And so I'm keeping this target in place. I'm not going to do anything. That's a gap fill target that we expect to fill right there at 351.35 for the diamonds. Now let's take a look at the Qs. The Qs just don't want to quit on the upside. The tech sector has been storming away. We had a forecast higher on the VIX Monday and Tuesday and into Wednesday with a pivot point. We're starting to see this pivot point again. If I zoom in here, you see we have a lower high and a lower low. We opened up on the low, but we still have a lower high, so that defines a pivot point. Keeping that also in place, Downside price target for the Q is at 368.15. Why is that? Because right here we have a gap that is still open. We expect that to fill. So again, keep your stops in place, protect any profits that you have, and make sure you're not overspending at these highs, because the markets do look a little tired to the upside. We're coming into September and October, of course, the most notorious months of the year. And that is why I am pushing so hard to get people to at least take a look at good risk management principles, especially using the 1% rule for managing risk. Now, I have been commenting on ETH, ticker symbol ETHE, and I had my gap targets set on this chart to the upside. Last week we hit and filled that gap. This week we filled the gap to the upside right here. So what does that mean? Well, yesterday, if you look at the second, we have a shooting star. That's the second most bearish candle you're going to find. And today we have more or less a spinning top with the oscillators moving lower. I'm going to erase all these lines now that the targets have been hit, and I'm going to redraw my downside target for ETH, which is not going to be much. I think we're going to pull back a little bit of what we had here in the rally of the last 5 days. But I'm putting a downside target on ETHE at 34.76. So for those crypto traders out there, keep an eye on that. I think there's a lot more strength this week and even into this new month than many have expected. So I wouldn't be surprised if we pull back and then find another level of support to bounce. Now again, on the risk management side, I'm going to bring your attention to a letter that Secretary of the Treasury, Janet Yellen, submitted to Nancy Pelosi, Speaker of the House. This went out on July 23rd. This is not getting as much press as it should. I'm just going to scan through this for you because I highlighted some areas. This basically is a warning to Nancy Pelosi that if the debt ceiling is not raised, that we are going to be in a tough spot with regard to the U.S. Treasury. You notice that my highlights here are more or less showing the number of warnings that went out. Look at the number of times Janet Yellen has used the term extraordinary measures. This was 5 times she'd used this in one short letter. And I've underlined here with some highlighter some of the warnings. Again, no need to read between the lines. It's in plain English right here. And please understand, when Janet Yellen writes a letter to the Speaker of the House, this is not just her putting it out and no one proofreads it. There's a team of people that review this every single word. So her use of extraordinary measures 5 times throughout this letter is something that cannot be ignored. She's putting out the warning and also warning that this could have devastating or irreparable harm to the U.S. economy and the livelihoods of all Americans. Again, I'm just pointing this out as a FYI. It's a major flag. I'll submit a link to this letter in the description box below so that you can read it for yourself. That's warning number 1. Now, the other warning that came about really was from Joe Manchin out of West Virginia. You see the warnings that are coming out, warning the Democrats to hit the pause button on the $3.5 trillion plan. All right, this is not yet passed. And what are investors going to think if all of a sudden there's no more money being pumped into the system? Again, this is more or less one of those hanging flags, if you will, that could put a damper on any new buying coming into the market. And these are the things that I look at. I look for news that could possibly sway the popular opinion by most investors and institutions. And that's another warning. On top of Bank of America putting out this research report where they're tracking persistent inflation as it compares to the Fed's transitory inflation. And we can see that the persistent inflation meter is quickly catching up to become more permanent, if you will. And so the Fed's narrative of transitory inflation is really dissolving very, very quickly. And so what's happening now are business owners and executives of key corporations are no longer able to stave off the effects of inflation, so they're now building it into their models. I often talk about business leaders and their actions and what needs to be taken, is especially with the labor shortage. What happens is companies have to raise their wages to attract workers, and those wages go up. They don't go down. So once you hire somebody at a higher wage, that's an inflation cost that's embedded now in the model, or the cost of that product or service. And in the end, guess who pays for that? That's you and I and everyone else that pays in the end. And inflation very much is a tax. So keep an eye on that. Just want to put a shout out to Dr. Billy. Dr. Billy is a friend of ours. I was on the phone with Dr. Billy on my way to the Florida Keys for a long weekend, and he mentioned that he's a member of the Conover Club. It's an investment club where he is, and just a shout out to that club because he's been sharing this weekly report with the members there, and I surely hope that everyone listening continues to share this report as I do my best, again, to educate people on the technical signals. I mean, let's face it, if you could look at a chart and get a good eyeball on what the target prices are based on price performance or history of price performance, you can see it's not that hard to pick out the fact that IWM is no longer in an upward trend. It's drifting sideways. And remember, my key trigger point for IWM is a close below 210, below that support level right here. This is where our members are going to start to move any positive positions out of the portfolio and going full speed ahead with negative or negative delta positions, particularly in options. If we look at the Dow Jones Average itself, I had some fan lines up here that I've kept. I don't get rid of those. And we have 1, 2, 3, 4. There's 5 fan lines on here, with the most extreme fan line now being broken. And it's not because the market is dropping from the highs, it's because the market is now drifting sideways. And by default, this fan line is going to be broken. And I say all the time, once a fan line is broken, there's now a 90% chance that the next fan line will be reached. And you can see there's quite a drop between the most current fan line and the next fan line in the sequence here. That fan line for the Dow is down there around 22,000. So again, good risk management skills are needed here. Embrace that. Don't be surprised if the markets drop. No one should be surprised by that. Just plan ahead, protect your profits, protect your cash, and we'll talk to you next week. Have a good long weekend, folks. So long.